Hi, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve, sponsored by Atlas Fiduciary Financial. So we all know that real estate has been a playground for the rich and the well-connected, and according to recently published data, it's been one of the best performing asset classes for many, many years, for modern history, years of modern history. So recently, over the past 30 years or so, there have been opportunities for the individual investor to actually get involved in real estate. And we wanted to talk to you a little bit about that today. Since 1991, actually, the barriers to getting into real estate have lessened. And it really was because there was a company that took their real estate investing public, and it offered these types of REITs that are called equity REITs. Now, equity REITs have ownership in actual properties, and they generate revenue primarily through rental income. That's different than what existed in the prior to that. Since the 1960s, REITs have been around, but they've been primarily mortgage REITs. And
That's right.
mortgage REITs are associated with the debt instrument. They're associated with mortgage-backed securities or mortgages, and they're impacted by interest rates. And so they tend to be more volatile and sensitive to interest rate fluctuations. And so we're focusing today, and we focus for you on equity REITs.
And so I want to mention that the problem with mortgage REITs as well is that they don't really have the relationship with the other asset classes that we hold in your portfolio that we're particularly looking for in the case of equity REITs. And it's the reason why we've only ever used equity REITs. And as Laura mentioned, the return has been quite good since 1991, as you can see in this graph. U.S. REITs have averaged about 11% a year, which beats the U.S. stocks by about 60 basis points a year, which is a phenomenal difference in return. Now, I will mention that REITs are a relatively volatile asset class, but when they're put together in a portfolio with other asset classes, or when you also rebalance the portfolio, it can dramatically enhance return in the long term, and also dramatically lower risk in a portfolio. And you'll notice also that U.S. REITs have soundly beaten bonds since 1991. Of course, with a lot more risk, but on the other hand, the return on REITs is very, very high.
So when we talk about why we have REITs in your portfolio, we're looking at three primary benefits for you. We're looking at number one, returns. The second is yields. And Steve, if you'd like to talk about yields as well, dividend yields.
Yeah, and this has been the average yield since 1991. As you can see, it's been much higher than stocks, and a significant portion of the return on holding a REIT comes from its yield or its income. And that income, as Laura mentioned, comes from rents, on the properties that they hold. And by the way, they don't just hold properties or other types of investments that they hold. Now we'll mention a little bit later in this talk. And by the way, the current yield, according to the Bloomberg terminal on the REITs we hold, has been closer to the 6 to 9% range over the last year. And that's one of the reasons why REITs don't quite move the same as stock, because the yield, which is a significant portion of the return, is so much higher than it is on the on large company stocks. So it really is a significant portion of the return. But I do want to mention that REITs are not the most tax efficient investment, and the income they generate doesn't qualify for the special tax rate on qualified dividends. And therefore, when we allocate your portfolio or a portfolio, we tend to lean toward having REITs and the tax deferred pieces of your investments or of your portfolio. In other words, traditional IRAs, 401ks, and Roth IRAs.
I'd like to add to this slide a little as well. I'd just like to say, well, first of all, the reason why they generate so much yield, so much income, is because they're not allowed to hold their income in their funds. They're required by law to pass it along to the investor. So they must pay out at least 90% of their taxable income to their shareholders. And so that's why it all flows to you. And so it's not taxed by the corporation and then by the shareholder. It just goes to you. And so you need to be aware of that it creates that kind of taxable income. The second thing that I wanted to mention as well is that that these products, these types of investments are really focused on very, very stable business models. And the managers of these funds are very involved in acquiring and developing high quality types of assets that produce recurring income streams. And so they are very strong in terms of being able to develop. And you see they're producing yields that are even higher than the bond yields.
Much higher, especially these days, much higher than bond yields. So we had mentioned that it's important to have REITs in a portfolio. And the reason is quite simply because of a statistical characteristic or term called correlation. The performance of REITs, they don't move in lockstep in terms of performance with the stock market, and especially with large company stocks. As you can see here, the average correlation, and the correlation is a measure of how much they actually do move in relation to the stock market, is 0.57 long term. And that means that roughly half of the time their price movement is synchronized with the stock market, okay? 0.57, and the other half of the time it is not, okay? And so by adding REITs to a portfolio, it reduces the risk of the portfolio on an overall basis. So this is one of the main reasons why we hold REITs in addition to their high return. Okay. Laura, would you like to add to that? I might have misstated the correlation a little bit, but I think that, you know.
No, I think it's fairly obvious that that it is not fully correlated with the market, the U.S. market and the bond market. You know, you're looking for income. It's not correlated with the bond market either. It's almost a little bit of an equity-like investment and a little bit like a bond investment, but it's got its own characteristics, which makes it a great addition to any good portfolio.
Now, I want to mention, I believe it's the yield that's predominantly the reason why it isn't correlated with the stock market, because we have seen, in particular this year, where REITs move together with the stock market. But ultimately, when you start to get that yield effect, as the yield, you know, as you accumulate the yield on the REITs, the correlation decreases, and that's really where that lower correlation effect comes from, we believe, from the yield.
Short-term correlations can be somewhat high. It
That's
was
correct.
this way, if you remember, Steve, back in 2008 as well. So the short term, but over the long run, not so much. And
that's
so
correct.
You know, we're always looking at the long run.
Yeah, we have to.
That we have to focus on the long run.
Yep.
And this slide just really talks to, some people will say, oh, REITs, you know, I heard REITs are dangerous. REITs are, we should stay away from REITs. And oftentimes what they are talking about is they're talking about private REITs. Private REITs are actually a different animal. First of all, because they're private, they are not required to disclose exactly what they're doing with the SEC. There has been fraud in the private space. So you have to be careful when you invest in private REITs. In addition, private REITs will have higher fees. So you want to be concerned about that. And thirdly, private REITs your money is not as liquid as they are in public. In a public REIT, you can get out of that REIT anytime you want to. It's just like a stock. You can sell it, you know, and get access to your funds whenever you want. With a private REIT, it's not always the case. Now, this slide actually talks to the fact that that although public REITs will tend to be more stock and bond related in the short run, when we start looking at what they look like more in the long run, they really do behave more like a private REIT. They really do represent the same type of exposure as a private REIT. So sometimes the private REIT people will try to persuade you to go with a private REIT because they say these are much more pure real estate and you're not getting as associated with the market. And yes, they're right in the short run, but in the long run, you can get the same exposure to real estate as a private REIT in a public REIT. They're 80% correlated over the long run.
And I want to mention also the other issue with private REITs, that you're depending on the expertise of one manager. Whereas when you buy a mutual fund that owns REITs, especially publicly traded, or an ETF, you have a diversified group of managers. So you're not just depending on the expertise of one manager. And additionally, we've seen with people, they get into the private REITs and there's typically a lockup period. And the only way to liquidate that REIT is to sell it back to the company that issued the REIT. So there's really a lack of liquidity there as well.
And there's a fifth reason, and that is that usually these private REITs are somewhat concentrated in their exposure. They're not diversified. And
That's
they're
correct.
usually concentrated in more of the traditional sectors, which I think is the next slide, actually.
Yes, it is.
Steve. So traditionally, the REIT market has been focused on the left-hand side of this slide, where, you know, office space and rentals and industrial, those types of areas. But over the last 20 years, it's been shifting quite a bit. Now on the private side, not as much so, but on the public side, the public REITs are starting to get much more engaged in things like cell towers, where you have HD video streaming and connected devices, and data centers where we have cloud computing and working from home, and healthcare, which is focused on assisted living and skilled nursing care, and self-storage, where we store our belongings, and alternative housing, which includes 55 plus and older. It includes student housing, those types of things. All of that are places where real estate is really booming. So sometimes, I mean, part of the reason why we even wanted to do this particular talk with you today is that several clients have come to us and said, really, should I be in real estate? I'm concerned about commercial real estate. They're concerned about office space. But if you look at the slide here, you can see, yes, office space in the past was a significant piece of a real estate.
As was retail, by the way, as was retail.
Right, but not so much these days. And so you don't have that same type of exposure. You have some great opportunity to get engaged in some of the new generation cutting edge real estate environment.
And that's the other reason why we use the mutual funds and ETFs. They can choose REITs that are in the markets that are going to represent the growth in this area. And a lot of people concerned obviously with office space now. More and more people are working from home after COVID. And also, of course, retail. We all know it's happened with retail because of the advent of buying almost everything online these days. But the REIT or the mutual funds and ETFs we hold can buy the REITs that are in the areas where the most growth is going to be projected in the future. And by the way, we mentioned diversification. International REITs are probably about half of our allocation toward REITs. And the reason is because they have an even lower correlation with domestic stock than domestic REITs do. And additionally, one of the reasons why we hold investments, international investments, is again because they don't move in sync with domestic investments. And international REITs have a lower amount of correlation with domestic stocks, so that means they move even less in lockstep. So they give us a large amount of additional diversification value, especially in relation to their return.
Yeah, and when we look at the different regions too, Asia, especially Japan and Australia, tend to be really hot areas for real estate right now, which actually brings us to a point that we were talking about, Steve, beforehand, where we were talking about passive versus active. And
Right.
you all know that we are agnostic to passive versus active. We want the best investment for you. And so we're never going to say everything should be passive or everything should be active. It depends. And if we're going to pay for active management, we want to know that the extra fee that we're paying for is going to deliver better returns for you. And this is a space where, although we do have some passive management, so we have both domestic REITs and international REITs, and in both of them we have an active and a passive exposure for you. The passive exposure just gives you exposure, but a much lower fee. The active management gives you that extra bump in return, because this is one area where they have shown that they're able to beat the benchmark, because they're very,
Yes.
very focused on understanding the sectors and the geographical areas, and there definitely is opportunity. It's not an efficient market like US large cap stocks. There's a lot of opportunity to pick and choose the investments.
One of the funds that we do use, I'm not going to mention a name here, but one of the funds we do use, we've actually been using it since 1995, believe it or not. And because they have been it's been a consistently solid fund, and it is actively managed, but it has typically beaten most benchmarks over its history. So we continue to use it.
Yes, they're experts in the industry. So
Yes.
that's what we're focused on, is they really know what they're doing.
Yes.
So that's a little overview of why we're holding real estate investment trusts in your portfolio. Again, the higher return, the higher dividend, the higher income, and the low correlation all make it a tremendous asset class to hold in your portfolio. The institutional investors have always have been holding these higher levels of this asset class in their portfolio for a while. More on the retail side, the brokerage side, not so much. We see a lot of new clients coming to us with no real estate exposure at all, or very, very little.
By the way, I want to mention he's seldom seat in 401k plans as well.
Right. But we believe very strongly that it has a significant role in your portfolio, and you will see over time, if you haven't already, that it's a good performer for you. So we want to thank you again for joining us today. And if you have any questions or thoughts that you want to discuss with us, please know we're always here for you, because after all, it's your smarter money.